Howdy everybody, I'm Gary and this is GLoPersonalFinance, where I talk about getting your finances under control, building wealth, and becoming financially independent. Your adult report card, credit score, is a powerful number that can affect your life now and in the future. Your score determines interest rates you pay for credit cards and loans and helps lenders decide whether or not you even get approved for those credit cards and loans in the first place. Some other businesses, such as insurance companies, have started to use credit scores to make decisions about you. Utility companies check your credit score before establishing a new service in your name. And some employers check your credit history, but not your actual credit score, to decide whether to give you a job, a raise, or a promotion. Protecting and building your credit score is more important now than ever, and how you handle those following 5 factors can make all the difference in determining your credit score. Stick around and find out what 5 factors affect your credit score. I need y'all to do me a favor. Hitting that thumbs up button really helps me spread the word about my channel. It pushes the YouTube algorithm to suggest my video to other like-minded people also looking to grow their wealth. Let's go over the first factor affecting your credit score: your bill payment history. Your payment history determines 35% of your credit score. In fact, how timely you pay off your bills affects your credit score more than any other factor. Serious payment issues like charge-offs, collections, bankruptcies, repossessions, tax liens, or foreclosures can devastate your credit score, making it almost impossible to get approved for anything that requires good credit. The best thing that you can do for your credit score is to make your payments on time every time. Even though I talk on my channel all the time to never keep a balance on your credit card, there are extraordinary circumstances where you might not be able to pay off your credit card in whole each month. But don't just not pay it. At the very least, you must pay the minimum payment. Paying the minimum payment on the credit card will not decrease your credit score. Number 2, your level of debt matters. The debt ratio determines 30% of your credit score. Credit score calculations, such as the FICO score, look at a few key factors related to your debt: the amount of overall debt that you carry, the ratio on your credit card balance to your credit limit, also known as the credit utilization, and the relation of your loan balances to the original loan amount. As a guideline, you should actually keep your credit card utilization at 30% or less, meaning only charge up to 30% of any card's available credit limit. So if your credit card limit is $1,000, never charge more than $300 to keep it under that 30% mark. Having high balances or too much debt can heavily affect your credit score. The good news is that your credit score can improve quickly as you pay down your balances. And number 3, your credit history age. How old is your oldest credit account? The age of credit is 15% of your credit score and considers both the age of your oldest account and the average age of all your accounts put together. Having an older credit age is better for your credit score because it shows that you have a lot of experience handling credit. Opening new accounts or closing existing accounts can lower your average credit age. For that reason, it's typically not a good idea to open several new accounts all at once. Spread it out. Number 4 is the types of credit on your credit report. There are 2 basic types of credit accounts. You have the revolving credit accounts like credit card debt, and installment loans like car loans and home loans. Having both types of accounts on your credit report is better for your credit score because it indicates that you have experience managing various types of different credit. It's even better if you have loans of different types of assets, such as car loans or home loans, in addition to credit cards, and maybe have a student loan or a personal loan thrown in there. So not having a certain type of credit, such as an installment loan, won't necessarily devastate your score. Number 5 is the number of credit inquiries. Each time you submit an application that requires a credit check, something called a hard inquiry is placed on your credit report, showing that you've made a credit-based application. inquiries take up 10% of your credit score. 1 or 2 inquiries won't hurt that much, but several inquiries, especially within a short period of time, can cost you many points off of your score. Keep your applications to a minimum to preserve your credit score. The good news is that only those inquiries made within the past 12 months factor into your credit scores, and then inquiries completely disappear from your credit report after 24 months. And please note that checking your own credit report results in a soft inquiry, which does not affect your credit score. So signing up for one of those online score checkers like Credit Karma will not affect your score however many times you look at it, which I definitely recommend that you sign up for Credit Karma so you can have a good idea where your credit score is. Knowing all these factors really help out in getting a good high credit score. Having a high credit score really helps out and gives you a prime interest rate when you apply for a loan. This can save you upwards to around tens of thousands of dollars. Hopefully you found this useful. It takes a long time to research, shoot, and edit these videos. Let me know in the comments below what videos you would like to see next. Stay safe out there, and I'll see y'all next time.